Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we're back after last week's hiatus from the accident. We're all set. So we're going to catch up on where we were last week, and then what is happening so far. So we're going to kick off with the Russia impacts and how they're reverberating through the system, and talk about what's happening abroad, what's happening within the U.S. and how are things shifting. And then we're going to look at demand destruction in segment 2. Where do we see it? Is it going to happen? If so, at what price should we see something like this? And it's because everyone has different views on when does demand destruction happen? How bad is it going to be? So that's what we're going to look at in segment 2. And then we're going to, in segment 3, we're going to look at the Russia discounts and how they're trying to entice buyers, and what are we seeing abroad when you look at pricing, because there's definitely a lot of moving parts to what is currently happening, to say the least. So just to kick off with where we are here, I thought this was a good chart kind of highlighting some of the different seaborne exports. And this was something that came from Reuters. You're just looking at what is happening from coal, crude, and LNG. You can see that on the coal side, that has started to get hit a bit faster. China has come out and said that they're just going to miraculously replace everything, and it's all going to be increased production within the country. We'll see if they can do that. As we know, there's a varying different types of coal. It's coal is not just one unique entity. Just like oil, there's multiple different types. You can see that LNG is starting to fall, but there's also something to be said on seasonality as well. But the LNG piece is just going to be what doesn't go to Northwest Europe, and instead do they try to push more into other areas, i.e. the Asian markets. Crude is going to be the one to watch, because right now there's talk on who's going to buy what, and are we going to see things being purchased. Just when we look at things, Glencore sought to sell a consignment for Urals at $30.15 below dated Brent. So to give you an idea, that's obviously the widest discount we've seen. And then Russian oil producers Surgut is offering buyers some financing flexibility on cargoes of ESPO, as more and more companies are looking to obviously avoid. And what they've essentially said is that you don't need your typical line of credit to buy the cargoes, because normally you can't get that cargo unless you have the physical LOC that says that, okay, you have the money for it. So that's a little benefit that they're trying, because they need to keep some of these products moving through the system. And then obviously the world also needs oil. So even though we should see some of these discounts or these the falling flows, it's going to take time to see that. And so crude should stay a bit stickier, if you will, versus some of the others. And then the question is going to be, how long does it stay? And then do we get additional loadings going to other areas? And we're going to show a different chart that kind of shows that we're starting to see some loadings increasing to specific locations. And the reason why that matters so much is because of storage. So Russia only has about 8 days of onshore storage, which makes it very difficult to kind of bridge some of this gap if there is an extended downtime in terms of when exports can get into the market. And then if you start nearing this level of the storage, you're going to have shut-ins. And then if you have shut-ins, how quickly can they come back online? Can they come back online? Do you have the equipment to do it? There's a lot of problems that can start to arise. Again, shutting in for a short period of time is not a big deal. It's just as it gets prolonged, that's when you can start to see a lot of these problems arise, which is in Russia's case, why they would look to discount cargoes to such a degree. People will buy it. We know India is going to purchase. We know China is going to purchase. The question is just going to be how much, because for India, it's not the shortest trip. So there's a decent amount of longevity in that travel. But again, for the right price, they'll still buy it. And it's just, as you've seen day rates go high, insurance go high, you need to cover that. So because the sailing time from the Baltics from the Black Sea to India is a lengthy trip, and they have to make sure that it can cover essentially what that would be. Now, ESPO, that we're still waiting to hear more on that. We'll talk more on in segment 3. So far, China hasn't said they won't buy it, but they've also been hesitant to make any new purchases. And I think they're really just trying to put as much stress as possible to see if they can obviously get the best price as possible. So those are going to be things to watch. We do expect them to buy. There's been talk about yuan, ruble, and then rupee versus ruble. Now, that is all possible. It would have to be at a fixed rate just because they don't want to be caught with a lot of the volatility. And then one of the things that we're also going to talk about in segment 3 is this comment about the Saudi deal where they would take yuan instead of dollars. But again, we're going to talk about that in segment 3 because it's not as cut and dry as or as scary, I guess, when you hear it and how it's being talked about in the market. Now, on a side level, before we go to the next slide, we just want to talk about that Thailand. They've said that they're going to freeze the local diesel prices till at least mid-April, as it considers other measures to try to offset. Because as for those that have been watching us, we've been talking about emerging markets are going to be the most exposed, because they have subsidies for energy, for food. So it's a sizable hit. Like the state oil fund in Thailand has 40 billion baht or $1.2 billion to subsidize prices. Vietnam raises gasoline prices to 2,999 dong per liter to a maximum of 29,824 effective 3 p.m. local time. So you've already seen that big shift going up, and we expect to see more of that, especially as we get some mark to market. Now, some of the departures from the Baltic, Black Sea, and Arctic, I think it's important to look at what has increased. So you can see the Netherlands fairly flattish, Germany flattish. It's really China and India that you're seeing those increased loadings. Now, they've been very quiet, if you will, about those loadings. Nobody wants to go out and say that they're happening. So those are things that we expect that to continue and remain elevated. So I think it's just an interesting backdrop. And to be clear, some of these cargoes were already purchased prior to the invasion. When you look at purchased in February for March loading and then March delivery. So when you look at what India and China are doing, they're just going to continue to buy what they had said they were going to purchase. The bigger shifts are going to be what is going to happen with Germany. We know Israel is going to continue to purchase. Israel has been, I don't want to say a safe haven, but a place that the oligarchs have been able to escape to on their planes and get picked up by some of their super yachts. Now, the reason why you might think, why would Israel do that? So when you look at Israel has a very specific target, and it's Iran, it's the Houthis, it's the Hezbollah. And when you look at Syria, Russia's essentially told Israel, as long as you don't hit Russian assets, you have fair game to hit either it be Syrian that is acting, or Hezbollah, or the Houthis, more the Houthis in that area, acting as Syrian, Iranian assets outright. So again, that's why we did have that strike in Iraq on one of our consulates that are being built, and what is an apparent hidden or discrete Israeli base. That was hit by Iranian missiles coming, ballistic missiles coming from within Iran, which is then going to come down to the Iranian deal, which we'll talk about in segment 3. But again, there's a lot of things happening. Now, when you look at China's commercial gasoline inventory, at the end of February is at 14.5 million tons, or 41% of capacity. Diesel was at 18 million tons at 40% of capacity. There was some views that they were actually looking to increase some exports, but so far all of that has been stopped, and they've asked anybody who had agreed to sell or was looking to sell on the export market to delay everything until at least April to get an idea of where is the market right now internally. China is facing a fairly sizable COVID increase, and we'll talk about that in segment 2, and then again in the economy show. Then when you look at oil and gas exports to China, they're rising. When you look at Russian oil exports, you can see that exports, imports, shares of crude oil and natural gas in percent. China's share of Russia oil exports is almost 32%. Russia's share of CN of Chinese oil imports. You get an idea of kind of the flattish nature. But when you think about China and Russia and some of the relationships, it's important to appreciate where is Russian trade in comparison to other markets, i.e. U.S. and its allies. And you get an idea of just how I don't want to say trivial, because Russia, that's why I think the headline is misleading, because Russia's sending something that China absolutely needs. So it's trivial in price, in the total, but not trivial in the product. And I think that's the difference that we wanted to show. But it's important to say, like, if, that's why when you look at China, they really have to be as neutral as possible. Just when you look at Chinese exports, the importance of not only the European Union, but the U.S., the other Asian nations. So it's not like they can come in and be like, oh, we don't need the U.S., we're going to back Russia. We're going to send kinetic materials to China, to Russia. Like, there's all this talk about military equipment, and we'll talk more on this in the Econ show. But remember, Taiwan, South Korea, and Japan have stopped all technology imports into Russia, which means that essentially Russia's gone to China saying, look, can you make up the difference of what we're losing from these other three nations? Now, can we see them, the semiconductors and technology show up in missiles and other military equipment? Sure. But it's not going to be like, Russia is asking for 1,000 tanks and China sends it. Like, it's going to be a bit more discreet and more on the parts and pieces side. So that's why it's so important to understand that as we start looking at total oil products, product stocks. So remember, this is looking back 2 weeks, so it's not going to have the data for that we're going to talk about later on. But the deficit widened from 118.5 to 125.2. And it was when you look at where that happened, as we've been saying with crude stocks, both land and floating, we expected to just go sideways. And that's what we continue to see, and we're going to continue to see that as well. When you look at, we're still in that bottom of the cloud, but again, still below that 3-year average. But just bumping sideways. It's the total oil products that we're continuing to see driving a large part of that deficit. So when you look at crude, land, and floating storage, it widened from 53.7 to 56.4. And then on total product stockpiles, it went from 64.8 to 68.8. Now, we normally have fairly sizable turnarounds in the U.S. Some of that has been reversed. We still have it in Europe. We're having it now again in China. So that's going to draw down some of those excess stockpiles while leaving some of that crude in tanks. So that's where you're going to kind of get that balancing act at this point. So then when we look at land storage, here you can see that, as we were saying, it's just going to kind of go sideways, but it normally builds. But that disconnect between offshore and onshore, I think, is the most prevalent here. And here you can see the deficit widened from 79.6 to 84.6. West of Suez, again, fairly sideways, went from 71.1 to 74.2. But then east of Suez, the deficit widened from 21.6 to 22.9. But we're actually seeing the east of Suez getting a little bit higher, and it's just because demand is waning a bit in Asia. And we'll talk more about that when we get to segment 3. But you're starting to see some of those impacts. Again, not surprising given where they are and the COVID shakeup. But again, that's just something. And then we'll obviously talk about inflation in the economy show. But then when we look at floating storage, here you can see that surplus narrowed from 26.3 to 22.1. West of Suez, it went from the deficit widened from 6.2 to 6.5. Again, small. All of that is being done by Europe and U.S. Gulf Coast, because West Africa still is at a seasonally adjusted all-time high, which is a bit odd when you look at the physical market, because if you were to look at the paper market, you would definitely say that this is something that would be a bit tighter. But we'll talk about some of the nuances in that, because some things are tight in the physical market. It comes down to which type of crude quality, and that's what we want to look at. And then east of Suez, the surplus narrowed from 36.9 to 33.9. That's going to stay stable, as we were saying, just kind of going sideways at this point, just because there is, again, there's a lot of crude on the water right now, and it's just that timing of when does it go from transit to floating storage, and Europe, we're not going to see floating storage. It's just going to be waved right in because they're trying to purchase local, just given the, some of the shortfalls there and the shortfalls on crude availability, again, because location matters. And the fact that they're shunning those Ural barrels, you have to find some sort of replacement, which is going to be a mixture of North Sea, European crudes, as well as U.S. crudes, and to a degree West Africa. But we'll have to see how much that continues to flow. Crude had a build of 4.35 million. It's still 77.5 million below the 5-year average. But again, as we've been saying, a large part of that is being driven by Pad 2. Pad 2 had a small build, and then Cushing had I'll call it sizable build of 1.79 million. But again, it's still very low in terms of the storage level. So it's not like we're getting this big correction. It's just we've had anything from 960,000 to 2.5 million draws. So to see this bounce is, I think, really expected, especially given the levels we're at and what working capacity has to be. And that's 21.7 million below the 5-year average. Pad 3 had a sizable build of 5.36 million. That is something that we think is going to remain stable. We did get some reactivations of facilities in Pad 3. Pad 2, even though it had a build, it actually had a sizable drop in imports. So as those imports come back, we expect builds to accelerate in Pad 2. And then once you factor in the SPR, the total build was 2.36 million, because if you remember, there's still that consistent sell down from the Strategic Petroleum Reserve. And then production is just all over the place in terms of where things are, but we'll talk more about that on Friday. Now, when you look at runs, runs had a big increase from 89.3 to 90.4. We were not expecting to see anything above 90 prior to the end of March, and realistically, more likely the 1st of April. So this is coming pretty quickly. You can see that it's above the 5-year average, but that's a bit misleading because you still have Uri in this, and Uri had that big drop, and it took a while for some of these things to come back. But when you look at the runs, the increase was really Pad 3. Pad 3 had an increase of 173,000 barrels a day. We can't compare it to the 5-year average right now just because Uri skews that. So that's something where it looks like it's back up, but when you take out the fact that on a year-over-year change, it's up 1.8 million, you get an idea that we're closer to still about 1.3 million off of what is normal. And then Pad 2 had a slowdown, and we do expect the Pad 2 slowdown to accelerate a bit. This is just giving you an idea of where Uri kind of kicks in. You see that big drop. So things start to normalize, not this week or next, but the week after. So we will start to see that kind of come closer, if you will, to where things normally are. But again, we don't see a huge increase from this level. We think at this point, as some of that Pad 2 comes down, Pad 3 stays here, we'll start to see some of this balancing act, which again is going to put us in this low 90s, let's call it between 90 and 91%. Now on the import front, here we had a net increase in imports of 76,000 barrels. Pad 2 had a drop of 410,000. That's, again, just a bit more of a seasonal side. There was some work on pipelines. There was some activity that was being done. So that will come back. It's still, even though it was a sizable drop, it's still only 41,000 barrels a day below the 5-year average. Pad 3 had a small uptick. We don't see that being too sizable at this point, as they try to manage, light sweet and bringing in some of this additional heavy sour. And then as we keep talking about Pad 5, very lumpy increase of 386,000 barrels a day. That should also dip. So realistically, if you're thinking about this week into next week, we should see Pad 2 and Pad 5 kind of flip, where Pad 2 has an increase, Pad 5 has a decrease, and then kind of that delta on if we have a net increase or decrease is going to be driven by Pad 3. When you look at imports, you get an idea that we're still on the Pad 3 front near record lows. We don't see that changing too much. Again, just kind of bumping along the bottom as we continue through this reduced period. And then when you look at pad 2, this gives you an idea of where we sit. We're hanging around, but as we've been saying, it's going to go between the 5-year average to new all-time highs, and it's just going to stay at the very top of that cloud, just because this is where we see a lot of the new line 3, things coming through and just maintaining some of that elevated stance. Implied demand. Gasoline had a small drop of 18,000 barrels a day at 8.944. That's 298,000 below the 5-year average. And I think it's important to appreciate there's some pieces to that, because when you look at what is happening in the implied demand, the U.S. is not going to get just this broad demand destruction. We're not going to go from 8.9 million to 7.9 million. Like that happened with lockdowns, but that isn't what's happening right now. It's more along the lines of, should I do something extra? We're coming into spring, we're coming into summer, and typically this is when you see an increase in activity. You see more happening. You see gasoline demand going up on a seasonal level. Demand destruction is just not going up in a seasonal level. You're just going to kind of have some of that replacement, because some people will travel, some people will do more, but then there's others that will do less, and that's going to be that balancing act. Distillate had a big drop of 883,000 barrels a day. That's a mixture of where we are in the heating cycle, where we are in heating oil, and then we did have a little bit of a slowdown in the trucking market. That should pick back up. We will get back to about 4 million barrels, but we are getting some decent heating. I should say decent heating demand going down. When you look at just against the average, we'll talk about that more in segment 2. So again, that's going to help kind of mitigate some of that diesel demand or distillate demand. And then, as we continue to say, jet's going to remain at about 1.4, 1.5, in that range. We don't see that changing. And then on the propane side, again, still strong, 264,000 above the 5-year average coming in at 1.532 million. That's going to stay strong, just given demand in the U.S., exports into the global market. So again, that's going to be a positive light. So just looking at gasoline implied demand, the only time we were lower over the last, since 2016 was in 2021. So, because you have to remember where we had those lockdowns, which was actually next week. I should say, well, let me just rephrase that. It was this week by date, but next week by when the data is reported. So just to kind of clarify, because you might be sitting there, it's like, I remember something happening March 16th. So that's just where you get that setup. But you see how 2022 is just going sideways. And that's what we're talking about. It's not we're going to have this gigantic drop that we had in 2020. It's just going to go sideways. You see that drop in 2021. That was the URI impact. That was the drop. And then you had that quick snapback. We're just going to go on this kind of path of meandering to the right. We will drift up a bit. I'm not saying we won't. We'll get some seasonality, but it's not going to be this huge snapback, especially as prices continue to hit, as prices continue to go higher. When you look at crude oil inventory, we're right at the 2015 levels. We expect this just to grind a bit higher and just get closer to 2018, 2015. You can kind of see where they intersect. So again, nothing too major on the build front. And then when you look at crude supply, that dipped just because we did have that big increase in refining activity, but we expect it to stay fairly flat. As we've been saying, we expect days of supply just to kind of live in this world, because refiners are going to match up. When are they ramping up, and then what are they importing? So then when you look at total crude and oil storage, you can see it's just going sideways again. It's something that we think is going to, again, continue as there's that balancing between what are products doing and where is crude oil storage. Now, on the gasoline front, you can see that the rate of change is still not as steep as previous, which is why we've been saying that we're going to get much closer to the 5-year average. It's going to have the same look as previous years. It's just not going to be as steep, which is why we do expect this to intersect in terms of what's in storage as we get to the first week of April, as we do have some of that demand falling off versus what normally happens. And again, you're going to see demand going up, but you want to look at what should it be doing, and it should be going up. But is it going up at the same rate it normally does? And the answer is going to be no, which is why that's going to leave a little extra in storage, getting us much closer to that normal average. Distillate, again, the rate of change accelerated, then kind of flatlined. That's going to start to again kind of flatten it. We expect it to come to that 29-year average as we do have heating demand coming down. And then really it's going to be 70 degrees here on Friday, so it's nice to get some of that warmth. But just because it's March and it goes from 70 to 30, everyone's kids are sick, including mine, which is always a bit tough. And now jet, again, it's just going to be what is left in the disty pool, what is pulled out into the jet pool, and it still remains fairly stable. Here you can see that the front of the curve is pulled back. And when you look at 90, we're only above 90 through the next 3 months. As you have that that steep backwardation. You're above 80 as you get through essentially into 2023, and then you're above 70 as you get into 2025. So again, you're still at a healthy spot, but you can see how the curve is kind of shifted down off of what we saw versus 2 weeks ago. The 2 weeks ago was just that green line. But again, we just expect it to stay within this range, especially further down the curve. You could see the front month move, but we think the curve is in a fairly good spot when you start looking at where is, quote unquote, natural oil. Is it 96? Is it 105? Is it 120? And when you start taking out some of these premiums, you've had a lot of volatility. It's probably something closer to 75, 80. It's going to be hard to say. We're just playing the volatility here. There's really nothing to push back on. Could we go up another $6? Sure. It's going to come down to headlines. Zelensky came out and said that they're talking and that the things are going fairly better. And then crude dropped, and then Putin comes out and Russia comes out and says it's not going that well, and then crude rallies $4. So again, be nimble. There's really nothing to say. We're just gonna kind of waffle back and forth until we get something sizable, and it's unlikely we get something too real at this point. COVID, you can see on the worldwide scale, has stopped going down. When you look at Europe, it has flatlined as well. The U.S. continues to diminish. And then when you look at why, it's Asia Pacific, Vietnam, South Korea, Japan, Thailand. But the one that we now included was China. So China now has a big increase, and that is leading to some additional lockdowns, which again, we're going to talk about in a bit. Now, when we look at pad 3, you can see pad 3 is following 2018 almost perfectly. We expect it to go a little bit higher before we see some of that drop off. We could see it a little bit sooner just because we did have some reactivation of refining throughput. But again, it's just we're at the highest level we've been at since for 2022 when you look at pad 3, and we just think it kind of continues to grind along those levels a little bit higher. Here's that bounce off of those lows from 2006. We've been saying it's going to start. You can see the rate of change flatlined and then started to go up. We do expect it to continue to grind higher, but again, at a very slow, stable rate. We don't expect this huge, like 3 million build, 4 million build. It's going to be more of that gradual move back up, but something similar to what we saw in 2007, where you kind of had that natural grind higher and the rate of change wasn't too steep. And then when you look at floating storage, we're still at all-time, seasonally adjusted all-time lows. And it's just because pad 3 is still pulling it in, and we're going to stay at the lower end of that number without seeing too much of an increase. So that's what we have for you on that side of the equation. And in the next part, we're going to go deeper into what's happening in the U.S. and what is happening with some of the demand destruction and just refined products in general.